Greetings, everyone, and welcome back to our Forex Mentorship Program for Beginners. Today, we are going to be looking at the types of analysis. And under the types of analysis, we have three major types of analysis in the foreign exchange market. We have technical analysis, we have fundamental analysis, and we have sentimental analysis. But we are going to pay attention only to technical analysis. Now, what is technical analysis? It is simply the study of historic price action in order to identify patterns and determine possibilities of the future direction of price. So technical analysis simply studies history and repetition of price action. Technical analysis refer to technical analysis as history repeating itself, and people who study technical analysis are called technical analysts. All they do is they look for repetition of price in the market and they capitalize on that to take trades in the market, either to buy or to sell. Before we go into the details of technical analysis, I want us to look at market structure. And under market structure, there are three major things that the market does. The market is either moving downward, it is moving upward, or it is moving sideways. How do you know which direction the market is moving? If you step into the market and you are looking at the market structure, all of this is categorized under technical analysis because you are studying price action, you are studying repetition, you are studying patterns that repeated themselves. And these patterns, when they repeat themselves, they give the definition of market structure. And most technical analysts always believe that they don't need to pay attention to fundamental analysis. Fundamental analysis is simply the study of news, the combination of geopolitical information, macroeconomics, and all the rest. Because all of this information is already represented in the form of charts. So if you are good at your chart, it is not even necessary to look at the news. But the news is so important, please. Do not despise the news. It affects price a lot. In future, we are going to study the types of news events that affect price. Now, let's look at market structure. Now, how do you know a market is moving down? When you look at your chart and you see price forming lower highs, and lower lows, it means the market is moving downward. It is in a downtrend. What is a lower high? What is a lower low? This is a high, and this is another high. But this high is lower than the previous high, so it forms a lower high. This is another high, this is another high, but this high is lower than this high, so it forms a lower high and it continues. This is a high, this high is higher than this high, but this high is lower than this high, so it forms a lower high. This is a low, this is another low, but this low is lower than this low, so it forms a lower low. This is a low, this is another low, but this low is lower than this low, so it forms a lower low. When you step into the market and you see a market forms lower highs and lower lows, know that that market is in a downtrend. It is trending downward. Two things are involved. If the last lower high gets taken out, it means there is a possibility that the market could reverse and start moving upward. Please pay attention to that. Every time the last lower high gets taken out in a downtrend, there is a higher possibility that the market could reverse and start moving up. We are going to look at the second example. Let's look at a market structure that is moving up in an uptrend. What happens when the market is in an uptrend? When the market is in an uptrend, it forms higher lows and higher highs. This is a low, this is another low, but this low is higher than the previous low, so it becomes a higher low. This is a low, this is another low, but this low is higher than this low. This low is higher than this low. this low is higher than this low. So this low becomes a higher low. This low also becomes a higher low because it is higher than the previous low. Don't get confused. This is a high, this is another high, but this high is higher than this high, so it forms a higher high. This is another high, this is a high, but this high is higher than this high, so it forms a higher high. So when you step into the market and you see a market forms higher lows and higher highs, that market is trending upward. We say the market is in an uptrend. If the last higher low gets violated or gets broken, there is a possibility that the market could be reversing. There are two things. If this low gets taken out, the market could be coming down here to grab liquidity. This one is going to be taught in the paid mentorship, smart money concept, and you could see price continue up. But if the market takes out the last higher low that was formed, pushes up and fails to take the last higher high that was formed, there's a possibility that the market could be reversing. This could sound strange, it could sound complicated, but don't worry. All you need to pay attention to is if I step in the market and I see a market form higher lows and higher highs, it means the market is in an uptrend. If I step into the market and I see a market forms lower highs and lower lows, it means the market is in a downtrend. The third category is the ranging market. A ranging market occurs when there is indecision. The market is neither forming higher highs nor higher lows. The market is not also forming lower highs nor lower lows. The market is just consolidating. When we see a situation like this, we say the market is in a ranging market or in a consolidating market, or it is at equilibrium. In a situation like this, it means the market makers or the liquidity providers, they are trying to fill in their orders, and it's not always good to trade in a market condition like this. This is a ranging market or a consolidation. Let's go into the market and see what we are talking about.